Hello and welcome to Macros with Mythili, our weekly half-hour show where we take a hard look at all the major macroeconomic issues and developments in India and overseas. This week we are going to focus on a macroeconomic puzzle. Why is it that for all the excitement and buzz created by rising stock market indices, the public at large prefers to steer clear of the market? To be sure, mutual funds report a massive jump in the AUMs or assets under management, courtesy the bull run. But at the end of the day, less than 5% of households really invest in the stock market, as against close to 50% in the US and a much higher percentage in banks. When it comes to financial savings, banks win hands down. Yet the fact is that the country desperately needs long-term capital, and this is best mobilized through the stock market, along with insurance and pension funds, of course. So what's holding Indians back despite the sizzling Sensex? We've got three experts to help join the dots. Subir, Gokarn, former Deputy Governor, Reserve Bank of India, and presently Head of Research at Brookings, India; Dhirendra Kumar, who's a byword when it comes to mutual funds; and Bhat, a former banker turned fund manager and presently Director, Dalton Capital Advisors. Welcome to the show, gentlemen. Subir, I may start with you. Why is it that the share of financial savings and overall household savings has, consistently been falling over the past few years, and within that the share of the capital market is even more minuscule? What explains this apparent aversion for the capital market when it comes to Indian households?
Well, I think it's a matter of relativity, but let me identify two or three factors that I believe are playing a role. They're both short-term and long-term factors. The short-term factor for the last several years, I think very clearly, is the negative real rate of return on bank deposits and so on, which is the primary mode of deploying discretionary savings. And it's logical that if people are not getting positive return on something, they will shift to something else. But what are they shifting to is, I think, the important thing. They could be, of course, shifting to the equity markets, but equity markets are somewhat remote, somewhat distant. And certainly when people think of long-term savings, and I'm not just talking about people at the at the first level of discretionary savings, even people with large pools of resources seem to find gold and real estate far more attractive alternatives for portfolio allocation than equity. Can you imagine then somebody coming into this market for the first time, into the space for the first time, just having enough money to save? Try going to a bank, try going to a jeweler. I think you get far better service in most jewelers than you get in most banks. Unfortunately, that's the reality. And so gold becomes a very, very accessible, very easy to invest in asset. Many jewelers, from what I hear, even neighborhood jewelers run very simple SIPs. You put in a certain amount of money every month, you get an equivalent amount of gold. They're trusted, the relationships. Banks are remote, stodgy, somewhat intimidating institutions, notwithstanding the whole financial inclusion drive. It's much more difficult for a first-time saver to make a connect with a bank than with a jeweler. So I think gold, apart from the relative rate of return issues, is also a much more accessible asset in our current market situation. So it's no surprise to me that as you're getting a cohort of people who are starting to achieve discretionary saving levels, the first port of call is gold, perhaps the second port of call is real estate. We've not yet matured as a market adequately to attract this cohort, this group of people in large numbers to the equity markets.
Dhirendra, would you agree with that? That if the first level of saver or even the second level of savers, for him banks are remote, the equity market is even more remote. But given the fact that we desperately need to raise the level of gross capital formation in the country, and the capital market is an obvious answer to that, what can we do to get more savers enthused into entering the equity market?
No, all of it is actually true, and what has happened in the market over a period of time, capital market has never been a mainstream investment. The way Indians are configured, or the way Indians have been driven to get configured in a manner that, think of somebody getting started with his career. His long-term saving finds a way into fixed income by way of provident fund, employee provident fund. Your tactical money once in a while in a seasonal way comes into the capital market, and historically, if you look at what has happened in the last 25 years, people were investing in infrastructure fund, or people were investing in IPOs or technology funds. Mainstream regular equity investment has never been part of the Indian savers framework. So that is one, and the natural fallout of this particular approach is that you are generally disappointed the perception about equity or the capital market, so to say, is that it is a risky thing. You lose it whenever you try it, whenever you have tried it, and that is the first hand experience. Unfortunately, the real estate, the folklore about real estate is that somebody bought a house and in 20 years see where it has been to. I think people lose one real estate holding by very design turn out to be very long term investment. You hold it for 10 years, 15 years, 20 years. People don't look at the annualized rate of return. There will be of course outliers. So is the case of equity, but compare it, if you compare on objective parameters for a long term investment, the ticket size, the risk, the concentration, I think the case for equity, despite being very compelling, no investor has ever experienced it. That apart, I think things can be in for a substantial change, because and of course gold is a different story altogether. What has happened to gold was a one time thing. What happened to gold was the financialization of gold and the whole global financial crisis, and it looked like an island of security that drove or attracted a very unusual attention, and that led to the bull run in gold, which may not be the real long term outlook for gold. And gold is by its very design, it will struggle to beat inflation. It will not be a productive asset. But there has been exceptional time in recent times, last 5-6 years, when everything is struggled except gold for some unusual situations, circumstances which may not be replicable. So my sense is, but things could be in for a substantial change if you go by what has been done in the union budget, 50,000 going into NPS, of which 30-40% can well find its way into equity. The other is in a very limited way, a very nominal start has happened. Today we might have about 30-40 lakh SIP accounts, which is nothing but almost like a predictable money finding. Of course, it is discretionary savings. Nothing has been done by the government on this front. Nothing has been done by the government to catalyze long term savings into the market. But this is discretionary voluntary savings finding its way into equity, and it has been so rewarding that the good word will spread, and it is accessible, it is approachable. But I also agree with what Subir said, that markets or banks are intimidating, they are not accessible, they are not as welcoming as other things. Today there are all kind of catalysts for spending your money, not investing.
Ravindra, Dhirendra said that the capital market, the perception about the capital market is that it's risky, and now with the growing dominance of FIIs, does that make it inherently more volatile and therefore make it even more risky as far as retail investors are concerned?
Not really. I think FIIs are participants in the market like anybody else. I do not think they add to the risk of the market. In fact, they add to the liquidity of the market, make it more attractive. Institutional investors in general, and FIIs also as part of the institutional investing community. But I think generally, inherently, people look at equity markets as a risky place. Even though in the long term, I think that is probably one of the only instruments which beats inflation very handsomely. But as long as you have guaranteed return products, like say this Sukanya Samruddhi scheme, which offers something like about 9.2%, I think most of at least the initial savers would probably go there, because I think unless there is enough of investable surplus savings, only then the money comes to the market. Like say for example, when the savings are high, like household savings to the order of something like about in 2007-8 was the highest, because the confidence in the economy was the highest at that time before the 2008 meltdown happened. At that time, I think there was quite some money coming into the mutual funds. Now again, I think after last year onwards, that is 2014-15, there has been significant inflow into the mutual funds. FII flows have also been good. Even insurance companies have got reasonable inflows. But I think finally it is a question of allocation of resources. As I said, security is very important for the first time earner. So therefore, he will certainly look at buying a house or taking a housing loan and buying a house. Only after that, when he generates some surpluses, then only he starts thinking in terms of investing. And as long as there are guaranteed products, I think that will be the first port of call. Only when he has got some sort of security, that is when he will look at savings through the equity markets, and that is what we have seen. Unless the standard of living generally goes up, you will not have too much money coming into equities. And if you see, the National Pension Scheme is a very good sort of alternative that has come to most of the employees in the organized sector. quite a lot of these NPS subscribers have opted for a slightly higher equity component, and that is of course it is early times yet, but if enough if it becomes compulsory for most employees, then I think that is the sort of money that will come in. Systematic investment plans through mutual funds, this is how I think money would come into the equity market, not so much small investors coming directly into the equity market.
Okay, so then we do expect to see money come into the equity market, if not directly, at least indirectly. But I'm afraid on that note, we have to slip into a very short break, but please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and we're trying to understand the puzzle of why Indian investors are staying away from the stock market despite the way it's setting new records day after day. Dhirendra, this time let me start with you. Mutual funds have been around in India for over 2 decades now. But why is it that despite all the kind of stops that have been given to mutual funds and SEBI's determined effort to try and promote them, the penetration of mutual funds is still so low?
Simply because, mutual funds have never been a mainstream investment. And I don't think any special incentive has been given for mutual fund, except for what happened with the tax saving funds.
Yes, huge tax breaks.
But that is a very nominal tax break, because if you look at there is only one tax break which is available to Indian savers for their savings, which is under section 80C, in which from the last year you can invest 1,50,000 rupee into specified investment, including some expenses. In fact, child's tuition fee is also part of that. That is considered as a long-term investment. But that apart, I would say that that is a place where long-term savings get completely crowded out. So my understanding is that mutual funds do not get any incentive. There is no incentive for investors to invest in mutual fund, because that section 80C, the first right to your 80C is your provident fund contribution, which is the case with all organized sector employees. Then comes your life insurance premium, which is a long term commitment. So there is hardly anything left for investors to experience equity by way of methodical investment. That apart, I would say that mutual funds are substantially to be blamed for this. Mutual fund has always been hawked and sold as a tactical one time or as a seasonal investment. Mutual funds are easy to sell when the going is good, and it is not so easy to sell when the going is not good, and the only way to approach it is pitching mutual fund as a savings vehicle rather than a tactical return enhancing investment, a one time tactical investment. And that has been the case. If you look at all the big things that have happened to mutual funds, you remember, the biggest fund in India started in 1992 with the master gain, when the market was at an all-time high in 1992. That was followed by, and if you look at all the icons of mutual fund, big mobilization in mutual fund, Morgan Stanley in 1994. Then came the technology boom in late 90s, when we saw that big technology funds in fact became some of the largest Indian funds. Then more recently, you'll recall that before 2008, we had this whole infrastructure boom, and some of the biggest infrastructure funds came into being in a brief period of time, and investors have been disappointed. When investors don't come in a methodical way at regular periodicity, investing their long-term money at regularly, not at one go, and expectations management. When investors come in a seasonal way at one point and invest a large amount of money in a brief period of time expecting huge return, it is a recipe for disaster, and we have only been witnessing a disaster every 5 years. So, this is the dynamics, and this is how the industry is configured. I think it requires a very systematic approach, unless and the only approach which can come in handy is making some regular, making some allocation to mutual fund where money is invested regularly, investor gets a tax break, and that will demonstrate the power of equity. In fact, by the time most investors figure out that their regular savings, their conservative approach, and investing in fixed income, which is the dominant way for investors to save, they will end up being very poor over a period of time, and they will realize this once they will not be able to, they will not be able to do anything about it. Because for equity to be productive, you need time, you don't need timing, and you need to be regular, you need to be disciplined. that can happen only with a regulatory framework which catalyzes long-term money for your retirement into markets in a definite way.
Subir, Dhirendra made a very cogent case for equity investment, and the fact is that actually equity investment may not be so much through mutual funds, but any kind of equity investment gets a number of stops, whether in terms of dividend income, capital gains exemption, etc. Quite unlike bank deposits, where there is TDS in fact on interest income. Yet despite that, these same investors and savers whom Dhirendra says are not particularly disciplined seems to still stick to banks and pay those taxes. So what explains this love affair that Indians seem to have with banks?
I think the mutual funds, equity are largely abstractions. For most people, they're remote, they're sort of complex, they're exciting. I mean, obviously, a lot of people spend time watching your and other channels, watching the stock market going up and down. Stars, there are the rock stars who have done well in the stock market, some positive, some negative. You have had the scams coming from people who are before that, heroes. So there's a lot of hype and somewhat sort of a sheen to it, but it's not us. It's not part of us. It's something we're watching from a distance. Banks are tangible, concrete, however frustrating they may be to deal with. They are concrete. They're there in the neighborhood. You go and you stand in line and you suffer all the indignities of dealing with a counter, but you get your job done and the money is safe. So I think we have to understand the psychology of first-time investors. They like concreteness. They like the idea of having a tangible asset, which is why I think gold and real estate are so attractive, apart from some of the other attributes. Equities are remote, and you keep hearing about ups and downs. You keep hearing about fortunes being made and lost. The only way you need a transition. You need something that gets people gradually used to the idea of owning risky assets. So there's a huge amount of education and awareness, sensitization that has to be done, and I see that happening. The regulators are doing it, the exchanges are doing it, some of the big financial conglomerates are doing it, but it's a slow, gradual process. It's not going to translate into overnight a kind of a bandwagon effect for equity. So I think it's important for people, for the system, not for investors. The investors are ultimately going to behave as they behave, to recognize that there is a slow transition from the current pattern of saving into risky assets, and you have to have both the products, which I think we have a limited number of mutual funds with tax benefits are attractive to people who pay taxes. They're not attractive to anybody else, and that isn't a very large number, as we know. There has to be products and there has to be distribution, there has to be delivery. I've been making the same point about the financial inclusion process. There's no point in pushing bank presence into villages if they're not going to offer people products that are appropriate to their needs. There's no point putting the same product that you're selling to urban customers into rural markets and expecting that to effectively achieve inclusion. That's not going to happen. You need customized, specifically designed products. And the same goes with equity. Unless you have the products and the delivery system matching up with each other, it's not going to happen. So I think we're living in a bit of a fool's paradise, think that the benefits and the merits of equity are self-evident, and everybody who has money to save should become immediately aware of them and start to use them. I think that's being very naive.
Okay, let me ask Ravindra. Subir talked about the scams and the distrust in the equity market. Has that distrust, the memories of the past scams faded, or is the market again, run way ahead so that retail investors are bound to burn their hands once again?
Well, that is the story of equity markets always, in the sense that most retail investors come at the fag end of the bull market and they burn their fingers, and then they again sort of sulk for about another 3-4 years till the next bull market happens. I mean, that's the story of direct participation in the equity markets. But be that as it may, I think what is more important is at the stage of development that India finds itself in. I think, and if you see, say for example, the number of income tax payers and the number of mutual fund folios, they are not dramatically different. So therefore, and since there is so much of stress on KYC and stuff like that, so I think all those, most of the people who are income tax payers and belonging to the sort of middle class, they are already there in the mutual fund sort of investment game, or otherwise they are directly, because even demat accounts are probably about a couple of crores. So I think most of them are there already. It is just that at this stage of development and at this stage of risk taking ability of the middle classes, I think this is thus far we can go. But I think a sustained bull market has the ability to attract a large number of investors into the market, and most of them, even if they get hurt once, and again when the equity market goes into another bull run, they get attracted. So I think if you have something like about 4 crore mutual fund folios, if you have about 2 crore demat folios, I think, and if you see the number of income taxpayers, they are not terribly out of skew with each other. So therefore, I think the whole idea is, as and when the middle income group increases, the number increases, that is depending again on the stage of development and the total quantum of household savings and investment. I think these things will go up. I don't think we are at a stage where people, more and more people can afford to take the risk of the equity market. It will probably take time with education, with affordability, with the surplus savings. That is when I think it will come, and I think we are well on the path of getting people into the equity market slowly, but I don't think there are any quick fixes for this.
Okay, so it is a slow process. We are nowhere near our full potential and we have a long way to go. But on that note, I'm afraid we have to slip into another very short break. But please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and we're trying to make sense of why this bull run has not translated into getting more investors into the stock market. Dhirendra, we can come back to you once again. Why is it that the bull run in the secondary market hasn't translated into anything remotely comparable in the IPO, in the FPO market, which is where the money really comes for the development of the economy?
Primarily because, you know, the recent boom which we have seen, which we saw or investors witnessed in 2008, translated into a massive disaster. In fact, that was the time when, you know, we saw a very unusual phase in the Indian market, when the market went up very steadily and went up by 5 times in the period 2004 to 2007. And in the fag end, I think the amount of mobilization by mutual fund into a set of funds which were, you know, where investors saw that they actually saw a massive, you know, depletion of their capital, and that has been very disappointing. Since then, 2008 to 2012, 2013, investors have been continuously, or, you know, mutual fund investors have been moving out of the market in a sustained way. This is the time, this is the period in which the, you know, gold really took off, or, you know, caught investors' fancy for a variety of reasons. And also real estate, the charm of real estate, that you have the physical, you know, the physical validation that, okay, something is there, howsoever big a racket it be. And the other thing that, you know, I find that the component of cash, the lack of, you know, the legitimate act, you know, the investment as a legitimate activity. You know, today doing your KYC is a very complex thing. Your ability to buy, you know, today you go and buy gold as much as you want to, exactly the way you go and buy chocolate. So, so I find it quite unusual that, you know, the KYC procedure, the way you actually make selection, mutual fund industry has contributed heavily to the complexity of it. We have plenty to, there is a problem of plenty, you know, and things have not been pitched in the right way. So, and I know it has not been economical. It does not make business sense for fund companies to pitch it the right way, because they, you know, they run a business, they have their focus, short-term focus. So I think lot needs to be done, and it will, it is unlikely to happen given the framework.
Subir, you've been a regulator for a long time, and SEBI as a capital markets regulator also has a developmental role. So what can SEBI do to reassure investors that the capital market is a safe place for them to enter?
Well, I don't think SEBI's role is to develop the market in the way of encouraging FPOs by lowering standards for issue. I think SEBI's role is very clearly to make sure that the market develops in a way which is safe for investors, so that, you know, fraudulent and weak kind of issues are not happening.
Yeah, market
integrity. I think that is playing
yes.
that role reasonably well.
Yes,
market absolutely. But it's really the reason why why IPOs and FPOs are not happening is because the investment climate is so weak. You know, people are not issuing stocks because they don't want to raise, they don't need to raise money for investment. For a cycle typically follows a pecking order. The first wave of investment is going to be financed from internal accruals. It's only after that that you start getting into the markets, whether through bond issuances or to equity issuances. We are not yet at the beginning of that cycle. So let's not get carried away with the absence of IPOs. IPOs are typically lagging indicator of a business cycle. It's only when the cycle is the recovery is well underway that we'll see IPOs. And if this recovery that we're seeing now, to whatever extent it's on, is sustains, and we start to see investment to GDP climbing again with more and more private investment, then I think we'll see the IPOs coming in, and we just have to wait for it. I don't think there's any puzzle or mystery as to why it's not happening at this point.
Ravindra, one quick last word from you on what can we hope for the capital market and the retail investor?
For the retail investor, I think there are enough incentives given as it is. It is just that I think there should be more confidence in the growth momentum. As was said, once the investment cycle picks up, I think people, entrepreneurs will start going back to the drawing board and starting to think about capacity expansions, new projects, and that's when the IPOs will come. I think we have a reasonably safe sort of market infrastructure for developing the capital markets. I don't think there is too much of an issue in that. I don't think there is anything much more that can be done. The only thing is, I think the time to the market can be sort of compressed a bit, because from the time you really start thinking in terms of raising money to the time actually the money comes into the bank account by way of an equity issuance, it takes a hell of a long time. So I think that is something that needs to be addressed, how that can be compressed. But other than that, I think especially with the ease in which money can be raised through QIP programs and things like that, I think the market is in good shape. I don't think there is anything much that needs to be done.
Well, on that optimistic assurance from Ravindra that the capital market is in good shape, we come to the end of this program. Thank you so much, Subir, Dhirendra, as well as Ravindra, for joining me. There's very interesting discussion. Thank you also for watching. But we'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at ET Now.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.